Hello, investors and traders. Welcome to Insider Investing. Today, we're going to present 6 statements, then delve into the probabilities of succeeding or why these statements is crucial for the stock market. Statement 1. How do you think about investing during an election year? One key component of our system is understanding where we are in the cycle of the stock market. An important indicator is the presidential election cycle, especially this year, given the unprecedented number of elections worldwide. Statement 2, IPO momentum. What does it mean to have a high number of IPOs and significant capital in them this year? We'll also explore what might happen next year. Statement 3, the US dollar will be stronger for longer. There's a probability that the US dollar will rise compared to the euro and other foreign currencies. We'll discuss how our stock market in the United States might react and which companies could thrive. Statement 4, inflation data could push rates cuts to July. With recent CPI and PPI releases, knowing when interest rates might drop or be priced in can significantly impact the market's direction. Statement 5, what will be the catalyst for the short term? Earnings seasons will test the stock market rally. How will earnings be in the next 2 months? Statement 6, we're still bullish on artificial intelligence sector and semiconductors. We're highlighting ARM Holdings, ARM, and considering buying further on pullbacks. This video will explore each of these 6 statements individually and then bring them together at the end for a weight of evidence analysis. Number 1, how do you think about investing during an election year? As we are currently in an election year, you might be wondering how the election could impact your finances, especially with a rematch between President Biden and former President Trump. It's natural to feel fearful during an election year and to be tempted to put your money under the mattress, but it's important to know the election years are surprisingly positive for the markets. In fact, the markets tend to follow a similar pattern every election year. As the markets lead up to the election, it becomes volatile due to the high emotions and fever pitch headline noise. However, by the end of the year, once president is elected, market gains certainly, which it likes. Since 1928, the market has ended higher than it started 75% of the time. And since the 1950s, the stock market has started up 83% of the time, typically up over 7% in previous years. The odds favor that in election years, 75 to 83%, this will be an up year around 7%. If you are playing probabilities, this year will be an up year. It is worth noting that it is the Fed earnings and where we are in the economic cycle that moves the markets, not presidents. So don't let your feelings about politics dictate how you feel about investing. Presidents can indeed pass acts and cause political and economic events in the long term, but it does not matter which party or who is in office. It is important to note that global elections are going on around the world, and the same predictions that the United States markets will be up in an election year also apply to countries that have their elections in the same year. Number 2, IPO momentum. In 2024, we witnessed 47 initial public offerings, marking a strong start for the IPO market. Companies raising 100 million or more constitute a significant portion of this group. The trend has been notable growth over the past 2 years and continues into the second quarter. While the number of IPO isn't record-breaking, the capital raised is remarkable. Activity in both private and public pipelines indicates a spring pickup underway. As we progress throughout the year, the IPO market remains promising, with many companies poised for IPO launches. The performance of these large deals, particularly in the tech sector, will likely drive continued activity. The IPO sector boasts a diverse range of companies spanning financials, industrials, and consumer sectors. What we have seen through the years of this IPO indicator, usually tops happen when there is a lot of companies going for IPO. As you look in 2021, 1,035 companies went IPO, and drastically a lower amount in 2023. Usually tops are formed in years with high number of IPOs, thus saying that this is a very different year, and because of the amount of money being thrown into these IPOs will constitute next year being a poor year in the stock market, but thus saying that this year, based on the capitalization being raised by an average number of IPO releases, this will be a positive year, and next year will be a negative year for the stock market based on the IPO indicator. US dollar will be stronger for longer. On Wednesday of last week, a hotter CPI number drove the dollar up amidst political unrest, wars, and doubts for rate cuts. The stronger for longer dollar could persist, given the resilience of the US economy compared to other major economies like Europe and China. The market consensus strongly favors an ECB interest rate cut in June, while speculation grows over a spring or summer rate cut for the Federal Reserve. Interest rates differentials favor the dollar amid geopolitical concerns, which impacted market prices last week, particularly in gold and oil. The possibility of a Trump presidency reelection and the potential reintroduction of tariffs could fuel inflation, leading to a shorter-lived easing cycle in other countries, sustaining the dollar's strength. The value of the U.S. dollar globally tends to drive the rise of the U.S. stock indexes. Over the last 2 decades, there has been a slight positive correlation between the value of the dollar and the movement of the S&P 500 index, with the S&P going up 40% of the time when the dollar strengthens. However, what matters more to investors is how the rise or fall of the dollar impacts the individual stocks they own. Companies reliant on imports typically benefit from the US dollar is strong, while those selling products globally thrive when the dollar is weak. We feel the dollar in the next few months will get stronger, and we also feel this will help the market for the short term and the intermediate term in this presidential election year. Number 4, inflation data could push rate cuts to July. The CPI print came in hotter than expected, causing a brief scare in the markets. However, when we delve into the data, we see that a core PC is tracking around 2.25%, which is quite different from the CPI's 0.36% reading. The Fed primarily focuses on a core PC, and the data looks more favorable in that regard. Particularly some prints, especially on the service side, were positive. For instance, motor vehicle insurance drove a 6-point base acceleration in core CPI. It's likely that in June is too soon for a rate cut, but we're eyeing July for the first interest rate cut. Thursday's data isn't soft enough to change the narrative significantly, but it does signal some progress. By June, it may not be convincing enough, but by July, we believe Fed could be cutting rates. Number 5, earnings seasons could test the stock market rally. Now that we passed the CPI and PPI, the next significant test for the market will be first quarter earnings. Many strategists believe that regardless of whether the Fed cuts rates this year, the main driver going forward will be the performance of the first quarter earnings. Earnings seasons always brings about new expectations and has significant impact on the market. The reason we're focusing on earnings is that higher interest rates can affect earnings, while lower interest rates tend to be the result in higher earnings. For the past 2 quarters, we've seen consistent earning growth, and the consensus is expecting a 3.2% earnings growth for the first quarter. It's anticipated that the top 10 companies in the S&P 500 will lead earnings, while the remaining 490 companies may lag behind. The key question is whether there will be a broadening rally of guidance to the other 490 companies in the S&P 500. Are they feeling comfortable with inflation and the impact of a rising dollar on their earnings? There are crucial questions for the next few weeks, and it'll be interesting to see how companies without AI leverage plan to address them. Many companies may highlight the demand for their products as a driving factor behind their earnings growth. ARM Holdings. In the past year and 3 months, our consistent recommendation to add QQQ Semiconductor and specifically NVIDIA to our portfolio has proven highly rewarding. Today, we are reaffirming our position on ARM Holdings, symbol ARM, as a valuable addition to short, medium, and long-term investment portfolio. This video will delve into compelling reasons to include ARM Holdings in your investment strategy, providing specific entry points for buying into this security. ARM Holdings, headquartered in Cambridge, is a UK-based company operating in the semiconductor and the semiconductor equipment industry. Boasting a workforce of 5,963 full-time employees, the company went public on September 14, 2023. ARM specializes in developing and licensing intellectual property IP for various devices globally, offering development tools that expedite expedite product developments across applications ranging from sensors to smartphones to servers. While the company currently derives substantial portions of revenue from a mobile communication, it positions itself as a pivotal player in the future of artificial intelligence by supplying chips tailored for AI applications. As a microprocessor architect, ARM competes with x86. ARM's popularity has surged in smartphone industry, constituting 50% of its revenues from mobile electronics. Major industry players like NVIDIA, Samsung, Amazon, AWS, and Apple rely on the ARM's code for their design. ARM's energy-efficient architect makes it preferred choice in the realm of mobility. The competition between different coding languages such as ARM and x86 carries significant implications in the tech industry, with approximately 70% of the population likely using ARM-based chips. The mere mention of artificial intelligence and the utilization of ARM-based chips in this industry could drive the stock even higher. This video aims to provide comprehensive insight into why ARM Holding is a strategic investment backed by its position in artificial intelligence, mobile communications, and efficiency coding language. To comprehend why investing ARM aligns with my investment philosophy, it's imperative to grasp the principles guiding my approach in the stock market. When navigating the complexity of the market, it's essential to select a strategy that resonates with personal preference and aligns with specific investment goals. In my case, my investment strategy is firmly rooted in a consistent weighted evidence, rule-based methodology, and a top-down approach incorporating analytics, data-driven insights, and technical analysis. I actively engage in trading across various timeframes, encompassing short, medium, and long-term perspectives with an unwavering emphasis on effective risk management in all my trades and investments. At the core of my approach lies a rule-based system which introduces a disciplined methodology to decision-making, effectively mitigating emotional influences and impulsive actions in the investment process. This strategic foundation has consistently guided my investment journey, providing a structured framework for making informed decisions in a dynamic landscape of the stock market. My recommendation is ARM Holding. Buy on the pullback. Before we get started, disclaimer, the information provided on our channels for education and informational purposes only and is not intended to be a substitute for professional financial advice. Protect your capitals by all means. I am a trader. I manage my own money. I am not selling you anything. I do not want anything from you. The majority of the times I do these videos is because I believe I become a better trader by explaining my ideas. Even thus saying that, you need to build your own system. Let's start with the beginning. And the beginning I want to start with is a philosophy of what's called continuation buying. During the advancing stage, particularly when the stock retraces back close to its moving average and consolidates, when the stock breaks out above the top of its resistance zone, in this scenario is known as a continuation buy. While this type of buy offers high probabilities of rapid advancement. If you look here, ARM went up, has pulled back close to the moving averages, and we feel that when this market starts going up again in the next 2 to 3 days, ARM will retest the highs. So we are looking to buy on pullbacks from 110 to 120. From a previous video on 220 of this year, we got in at 116. The current price is 126.33, and we are believing in a continuation buying and advancing stock on pullbacks. Let's go over some more reasons of our investment philosophy when buying. Are we in a bull market? Even though we pulled back, we are still in a bull market. We use oversold indicators. We could possibly have 1 to 2 more days on the short-term pullbacks on our oversold indicators. Is ARM and artificial intelligence companies cheap? It is not cheap. It is expensive. We prioritize uptrends. Is ARM in an uptrend? Clearly, no one's going to say that ARM is in a downtrend. They can say that they believe it's at the high right now, but it is not on a downtrend. We have our stop losses in play, and we're maintaining our consistency on our approach. If you also look at the sectors of semiconductors, we feel it's in a positive sector, but we feel 1 to 3 days we could possibly have a little bit more of a pullback, and I would be looking at the VIX to help you anticipate what's going to happen short term. Let's continue further. If you look at the Magnificent Seven, which has been moving the markets, 5 out of the 7 clearly look to be on uptrends. Only Tesla and Apple's are in a declining phase. Here is our only concern, and this is short term. If you look at our short term indicator here, we possibly could touch 0 and then move up from here. And at 52 and on a downswing, this is why 1 to 3 days, we could possibly have more pullback on this market, and we will be using the VIX as the indicator to tell us when we have reached a short-term indication to buy in this market. If you look at the short-term, medium-term, and long-term indicators, again, these are very neutral, so we're waiting for a little bit more of a pullback. What has worked very well 2 years ago has been the overbought, oversold components, and we're hoping it comes back into favor. But a number at 37, I would rather see a number at 25 to know that we have reached a short-term bottom. The CCI indicator is hovering around the 0 and could possibly go down to the minus 100 before an uptick. So in conclusion, with a statement, we believe ARM Holdings, which is the architect and the language of the NVIDIA chips, and many other companies are using the ARM architect with a strong sector with an uptrend, buying on pullbacks, and seeing the potential for the next 6 months to ride this stock upwards. We continue our strong bullish recommendation on ARM. I study over 100 indicators weekly, bringing them together for a weight of evidence. I come up with a probability of succeeding. I encourage you to develop your own system and plan. The 6 statements I presented today aim to build a case for this year being bullish in the stock market. Statement 1, in the 4th year of a presidential election cycle, we're typically up 8% on average, with a 75% of being up this year. The odds are favorable that this year will be an up year. Not as good as last year, but still very good. On any pullbacks that is lower than 8%, I believe we will come on average 8 to 10% up this year. Statement 2, record capitalization IPO suggests a positive year for raising capital. However, next year may not be as promising. What we have seen when we have this number of IPOs, but more importantly, the amount of money that is being raised by the IPO, the investment banking firms know this will be a positive year. But what usually follows both the president election cycle and capitalization in IPOs is next year a poor year, not this year. Statement 3, the US dollar strength correlates with the S&P 500's performance, adding weight to our bullish case. We have seen when the dollar is stronger, the market rallies better recently, and we feel the dollar will be stronger against the euro. Statement 4, inflation data could prompt rate cuts likely priced into the market well before July. Rate cuts will happen in July, and this will be priced into the market. And when this information comes close to a high probability of happening, we will have a very good day in the stock market. Statement 5, earnings seasons will be pivotal, especially for companies not involved in artificial intelligence. It will be super important the next 1 to 3 months how these companies in the S&P 500 and the NASDAQ and the New York Stock Exchange are giving guidance for the future. Even with high interest rates, are they predicting better sales and better profits? Statement 6, the semiconductor sector with companies like ARM is driving the bullish trend. If all this is saying true that we are in a bullish year, we stated in January, this is going to be a very selective year, and ARM will be one of the companies that will be moving higher. Putting it all together, with an expected 8% average gain this year, companies like NVIDIA, AMD, and ARM are poised to lead. On a side note, before we finish this video, we believe the VIX will aid the short-term timing. Good luck with your trading and investing. Remember, study it, analyze it, adapt it. Peace.